Okay, let's dive into this. Because right now, something is happening in the financial world that honestly shouldn't be possible. We've got two assets that have spent 100 years moving in opposite directions, and now they are both exploding to record highs at the exact same time. So in this explainer, we're going to figure out what on earth is going on. So here we are in 2025, and the markets are sending a signal that is just deeply contradictory. It's a paradox that has even the most seasoned investors scratching their heads because it feels like the old rulebook has just been thrown right out the window. And this is the core question, right? For 100 years, the choice has been pretty clear. It was either optimism or fear. You either bought stocks or you bought gold. But right now, the market is screaming both. So what gives? On one hand, you have pure, uncut optimism. The S&P 500, the big benchmark for the US economy, has absolutely smashed through 6,800 for the first time ever. This is a huge vote of confidence in growth, in profits, and it's all being driven by the AI revolution. And then you have this, gold, the classic safe haven asset, the thing you buy when you think the world is ending, has also shot up to a record-breaking $4,200 an ounce. This isn't a signal of optimism. This is a signal of deep, underlying fear. So how can both be true at once? To solve this mystery, we need to zoom out, way out. See, for the last century, markets have been dancing to this really powerful, almost predictable rhythm, and understanding that pattern is the key to unlocking what's happening in 2025. This whole thing isn't just random noise. It's what's called a long wave cycle. Think of it like the market breathing, a long breath in and a long breath out. You get these huge periods of amazing growth where stocks create incredible wealth, and then they're followed by these long, grinding periods of stagnation, where hard assets like gold completely take over. And this slide just lays it out so perfectly. Look at that clear back and forth. You have a 20-year stagnation, then a 17-year boom, then 16 years of stagflation, followed by an 18-year tech boom. And after the dot-com bust, another 13-year lost decade before the AI bull market kicked off around 2013. You can't deny it. The rhythm is there. Now here's where you can really see that inverse relationship in action. During the stagflation of the 70s, stocks got absolutely crushed in real terms, down 70%. Meanwhile, gold had one of its best runs ever, soaring over 2,300%. Then the script completely flipped. From 82 to 2000, stocks went up 1,000% and gold got destroyed. See? Those were the rules. One goes up, the other goes down. Simple. Until now. And this is the whole point. We are no longer playing by those rules. That historical rhythm we just talked about, it's breaking down. And it's breaking down because a new, much more powerful force is taking over the entire market. This isn't about a normal market cycle anymore. This is way bigger. We're talking about a fundamental shift in the very nature of money and debt. A whole new economic reality is emerging, and that is the key to solving our paradox. And that new reality has a name: fiscal dominance. Put simply, it's the point where a government's debt gets so massive that the central bank isn't really independent anymore. It's forced, whether it likes it or not, to keep borrowing costs low for the government, no matter what that means for inflation. So why are we talking about fiscal dominance now? Because of this number, $38 trillion. That's a U.S. national debt in late 2025. I mean, it's a number so huge it's almost meaningless, and it creates this mathematical trap that there's really no easy way out of. And this is where that giant number becomes terrifyingly real. In 2025, just the interest payments on the debt are now bigger than the entire U.S. defense budget. Think about that. We are spending more money just servicing old debt than on the entire military. This kicks off what's basically a vicious feedback loop. To pay the interest, the government has to issue even more debt. But flooding the market with all those bonds pushes interest rates higher, which then makes the next interest payment even bigger. The central bank is totally trapped. If they keep rates high to fight inflation, they could actually bankrupt the government. And that brings us right back to our paradox in 2025. This new reality, this age of fiscal dominance, is the reason that two assets that should be enemies are now rising together. So here it is. Here's the solution to the puzzle. The game isn't stocks versus gold anymore. The game is hard assets versus the future value of the dollar. Investors are looking at that debt spiral, and they're concluding that the only way out is for the government to eventually print money. So they're getting out of the dollar and into anything real. You can think of the whole modern economy as this giant tug of war between two massive forces. On one side, you've got the incredible deflationary power of AI and tech, which is boosting productivity and holding up stock prices. But on the other side, you have the massive inflationary force of government debt, which is pointing to currency devaluation, and that's sending people running to gold. And right now, both sides are winning. And this is exactly why the old models don't work anymore. I mean, traditionally, gold should be falling when interest rates are positive. But the market today just flat out doesn't believe these rates can last. They see the debt math and are basically betting on an inevitable return to money printing. Gold isn't just an inflation hedge anymore. It's become a hedge against the creditworthiness of the US government itself. Okay, so if the old cycle is broken and we're in this new era of fiscal dominance, what does that actually mean for the future? Where do we go from here? This table just puts it all together, doesn't it? You can see that beautiful, clean, alternating pattern between stocks and gold for decades. But then, look at that last row, 2025. The pattern is broken. Both are moving up. It's signaling that we are in a massive transition to a new regime, one that's not driven by growth or inflation alone, but by the crushing weight of government debt. And this quote really just sums up the whole dilemma. The central bank has an impossible choice. Do they protect the value of the currency by keeping rates high and risk a catastrophic debt crisis? Or do they protect the system by printing money and sacrifice the currency to do it? History tells us again and again they will always choose to save the system. And that leaves us with the final and most critical question. If the rules of the last 100 years don't apply anymore, and we are entering an entirely new phase of financial history, what does the next decade of this great transition actually look like? The answer is far from certain, but one thing is for sure. The incredible forces of technology and debt are on a collision course, and the paradox of 2025 is probably just the beginning.